Most people say they want to invest. Very few actually start. They read articles. They watch videos. They wait for the perfect time. They wait for the market to calm down. They wait until they understand everything. And while they wait, years pass. Here's the truth. You will never feel fully ready. You start anyway. Investing is not about being a genius. It is about following a simple system consistently for a long period of time. If you are a beginner, the first thing you must understand is this. Investing is not gambling. Gambling is putting money into something you do not understand and hoping it explodes. Investing is putting money into productive assets that generate long-term growth. There is a massive difference. Now let's break this down step by step. Step 1 is financial stability. Before investing, you need 3 things: a basic emergency fund, no high-interest credit card debt, stable income. If you are paying 20% interest on debt while trying to earn 8% in the market, you are going backwards. Eliminate toxic debt first. Step 2 is understanding what you are buying. When you buy a stock, you are buying ownership in a company. When you buy an index fund, you are buying small pieces of hundreds of companies. When you buy a bond, you are lending money. When you buy real estate, you are buying a physical income-producing asset. You are not buying numbers on a screen. You are buying ownership. That shift matters. Now, here is what beginners get wrong. They try to pick the next big stock. They chase hype. They put everything into one idea. They panic when markets drop. They sell when fear rises. That is emotional investing. Successful investing is boring. If you are starting from zero, the simplest approach is broad diversification. Instead of trying to beat the market, own the market. That means low-cost index funds that track large groups of companies. Over long periods, markets have grown despite recessions, wars, political shifts, and financial crises. Volatility is normal. Growth over time has been consistent. Now let's make this practical. Imagine you invest $500 per month into a diversified index fund, earning long-term average returns. After 10 years, you may have invested $60,000, but your account value could be significantly higher due to growth. After 20 years, compounding accelerates. After 30 years, the difference becomes dramatic. Time is your greatest advantage as a beginner. The earlier you start, the less you need to invest later. Let's compare 2 people. Person 1 starts investing at age 25 with $500 per month. Person 2 waits until age 40 and invests $1,000 per month. Even though person 2 invests more each month, the early starter often ends up with more wealth because time multiplies money. Time matters more than timing. Now let's address fear. Markets go up. Markets go down. News becomes dramatic. Headlines scream crisis. If you invest consistently and diversify, downturns are not disasters. They are discounts. When markets drop, your monthly investment buys more shares. When markets recover, you benefit more. The worst mistake beginners make is stopping during downturns. The market rewards discipline. It punishes panic. Before we continue, if you want practical step-by-step financial education without hype, subscribe to this channel. We are building a complete roadmap for wealth. Share this with someone who keeps saying they want to invest but never start. Now let's talk about allocation. If you are young, you can typically tolerate more volatility. That means a higher percentage in growth assets like equities. If you are closer to retirement, stability becomes more important. That means balancing with bonds or income-producing assets. There is no perfect formula, but diversification reduces risk of catastrophic loss. Another beginner mistake is overcomplicating everything. You do not need 20 stocks. You do not need daily trading. You do not need constant monitoring. You need consistency, diversification, low fees, long-term mindset. Fees matter. High management fees eat into returns year after year. A 1% fee may not sound large, but over decades it can reduce total wealth dramatically. Low-cost investing increases your probability of success. Now let's talk about automation. The easiest way to invest is to automate it. Set up monthly automatic contributions. Treat investing like a bill. Do not wait until the end of the month. Do not rely on leftover money. Pay your future self first. Investing is not about intensity. It is about repetition. You do not need to be rich to start. You need discipline to start. Start with what you can. Increase contributions as income grows. Reinvest dividends. Ignore short-term noise. And understand this clearly. The goal of investing is not to get rich fast. The goal is to become financially free slowly. When your assets grow large enough that returns cover your expenses, work becomes optional. That is financial freedom. Investing is how you move from working for money to making money work for you. It does not happen overnight. It happens through decades of consistent action. Start early. Stay consistent. Own assets. Reinvest returns. Be patient. That is the formula. If you begin today, your future self will thank you. If you delay, time becomes your enemy. The choice is yours.